And you think back to the industry before 2009. So 2009 was a pivotal year. You got in at a really interesting time, not just because of financial crisis, which was obviously crazy, but also because PacLife became the #1 seller of IUL in the country in 2009. Prior to that, it had been, Indy Life, Ameris, Aviva, now Accordia, owned by Global Atlantic. But that company had been #1 for years. And if you look back at that old marketing material, that company sold IUL. And I'd put National Life in this group too. And some of the other kind of early adopters.
I think #4 when I joined them in the country as far as.
And they were really telling a very simple story, which was, this is a product that offers downside protection with upside potential. And that is a powerful, intuitive story. And by the way, the product does it. Now, with an asterisk, right? And the asterisk is, you can lose money because the policy charges are still deducted.
Hey, what's going on, cash flow hackers? It's Chris with Life 180. And today I have a special guest that I've been excited about getting on the channel for a long time now. Finally got him roped down. His name is Bobby Samuelson. He runs a blog called LifeProductReview. I'm not even going to try to introduce him. I'm going to let him introduce himself to kind of give his background, give his expertise, and kind of talk about what he does on a day in, day out basis, who he works with. Because I'm telling you, I do a lot of research in this space, and he is better than anybody that I've ever seen at breaking down all the nuances of different life insurance products. And so really excited to have a conversation with him. But Bobby, thank you for being here, first and foremost. And if you could, I'd love to have you just kind of start by giving a little bit of your background, tell people a little bit about who you are, what you do, and ultimately why your opinion should matter to them.
We'll see about that. Well, I appreciate you having me on, Chris. I know you're a subscriber, and very cool what you're doing here at Life 180. So I'm honored to be on. My quick background is I'm 3rd generation in the business. My granddad started selling insurance in the 60s. My dad started in the 80s. My mom actually was rookie of the year at Principal before she had me. So insurance is in my blood. I went to go work at NFP right out of college. Fell in love with product on day one, man. I sat down. I was working in the home office there, and they had me run an illustration. And I turned to the guy next to me and I said, "Where did these numbers come from?" And he goes, "Oh, it's just a bunch of actuarial stuff." I'm like, no. Where did the numbers come from? So I worked there for a year in the product management area. And then I went off to go start my own little business at the ripe old age of 24, 23, somewhere around there. And basically it was helping producers close large transactions. So you have, very high-end producers who know how to sell insurance, know how to put it in estate plans, know how to put it in business plans, but they really don't spend a lot of time on product. And so I was their product resource, and I basically structure the transactions for them. Along the way, this product called Indexed UL starts appearing on the scene. And I had been the kind of in-house expert on Indexed UL at NFP. And the way that I would say that kind of landed on my desk is it was the least important product in our portfolio, and I was the least important person on the team. And so it was a perfect fit. And so I loved learning about the product. I mean, it's a fascinating product. It's got a lot of kind of twists and turns to it. The options layers of it make it really interesting. And so I kind of fell in love with the product, at least from an educational standpoint, and people needed to understand the product. And I remember being in meetings and I would be on stage and I'd say, "How many of you guys have heard of Indexed UL before?" This is in 2009. And nobody would raise their hand. And so I kind of became an expert in the industry on Indexed UL, started doing a lot of speaking engagements. 2012 rolls along. I started a newsletter, the LifeProductReview, which is, kind of still what I'm doing today. And I wrote a lot about Indexed UL, Guaranteed UL, whatever else. Traveled a ton, ended up going to work at MetLife. So I was VP of product development at MetLife. So I wanted to get off the road. Left there 3.5 years later as senior vice president and head of product development and pricing for life insurance and annuities. So I did all the product development for them, and that MetLife became Bright House at that point. So 2017, that's when I left Bright House, and I'm back to doing the Life Product Review, which I love. And again, thank you for being a subscriber. And that's a great fun outlet for me. Still giving presentations, and I actually run a product development company as well, mostly on the annuity side of the business, helping companies create really unique annuity concepts. So that's what I do.
I love it. So I'm going to just give you this little plug, and it's going to be a pretty strong one because I believe in it so much. Guys, if you're an agent and you're watching this, I believe you're irresponsible if you're not subscribed to Bobby's blog, Life Product Review. And because especially if you're selling Indexed Universal Life, you need to understand all the moving parts of it. If you're going to be putting the financial future of your clients, hands in this product, you better be understanding way more about the product than just what your wholesaler is teaching you about it on how to sell it, And so, whether you keep going down that path or not, like it's just, you got to be educated about what you're doing. I believe you have a responsibility to the people that you're serving to really educate yourself to that level. So anyway, go to lifeproductreview.com. I'll put a link in the description below, guys. You can go down and check that out and go from there. But so that's awesome, man. So you have like a level of understanding around this stuff, and you're, I mean, what did you go to school for?
Not this.
Not this.
Yeah, well, it's actually kind of a funny story. So I'm a math guy kind of by trade. So econometrics was my thing. So I was an economics major in college.
Okay.
And I had a business minor. I'm sorry, I was triple majoring. I had an economics major, a business major, and an accounting major. There's a lot of overlap, right?
Yep.
But I ended up graduating a year early, and man, by God's grace, I graduated in 2007, before the financial crisis hit in 2008. Oh, wow. And I would never have gotten my first job at an NFP had I graduated actually on time. So yep. I knew nothing about what my dad did for a living. He never talked about his work at home. He didn't want to like drag me into it. Sure. So I literally graduated, got a job at NFP where my dad was kind of placing his business at the time. And that was the first time I'd ever even really heard of life insurance. So yeah, but I'd say I'm a math guy by trade. I'm not an actuary, but I like to joke that I play an actuary on TV. And when I worked at Bright House, I had 30 something actuaries that worked for me. I have an actuary that works for me now. I work with actuaries all the time. And so that's really kind of my world. I know the sales and distribution side, again, from my dad and from working for distribution companies, but really, yeah, I'm a product wonk. And I appreciate what you said about the Life Product Review. I mean, it really is designed to be an in-depth, deep dive into how the products are built. And the reality is there's just not that many resources for people out there who are trying to understand these products. I mean, to your point, otherwise you're talking to a wholesaler. Yep. And the wholesaler doesn't really know it either. And so that's where I've kind of designed the Life Product Review to fit, is kind of between what the carrier says and what the producer's actually doing, is kind of filling in the gap between those two things.
So I think this will be a fun place to kick this conversation off. So I have one of my agents on the Life 180 team was like, hey, Chris, I have a call with a client, and she's thinking about getting a policy with me, but she's also she's been talking to this guy at PacLife, right? And so, in talking, so she's like, she's going back and forth. She can't, every time she talks to me, and I've spoken with her, she goes, every time she talks to me and she gets really excited. And then she goes talk to this guy. And then she, he sells her, and she's like, I can't make a decision. So ended up, this woman was like, will you get on the phone with this PacLife agent? And I'm like, sure, Mom, I'll do that all day long. That'll be fun.
Right.
So I get on with him, and turns out he's one of the top agents in the country, for WFG, and they, like whatever, he's one of the top like industry leaders for them, making over $1 million a year, doing all that stuff. Right. Wow. And on this conversation, I mean, the guy at his level, he had no idea what he was talking about. Like everything it was all like everything I would say would redirect to a script. But when it came down to like actual product knowledge, it was just not there. Right. And, and so like, to me, that just goes to show, just because somebody is successful doesn't mean they really know what they're talking about. And so like, from that perspective, I guess that's why I'm so passionate about having people like check your stuff out, because like really understanding that, understanding the products side of it and the nuances, it cannot just be about selling people. I just believe, I just believe it has to be more than that. And so one of your last posts that you made was about, I can't remember what the title is now that I'm saying it, but
I wouldn't remember either.
Basically the evolution of like the new, what is like the way that people are selling, the new conversations, basically
the narratives.
IUL, the narratives. There you go. That's the word. So we've gone through this process, right, over the past, since 2009, since Great Recession, right? Like when IULs, became popular. It was funny. I got into the IUL space in 2009, right? Like that's when I joined. And so it was like, boom. And I bought into it, hook, line, sinker right out of the gate for about 3-4 years. And then I was like, whoa, this isn't what I thought it would be.
Right.
For me, what happened was when I was at NLG, I was selling Flex Life 1 products at the time. And then Flex Life 2 came out. And then as I was doing annual product reviews with my clients, I'd see that the cap rates on Flex Life 1 were already going down. And they weren't performing. I was like, whoa, this isn't
not what you thought.
Not what I thought I was selling. You know what I mean? And like, how can that be? And so can you walk kind of through just like the last decade and like why this is kind of so scary?
Yeah, well, and I mean, I lived it, right? So when I think back to my first time I ever saw an index UL, it was in 2007. And so I've kind of lived this narrative change. And I'll even go back before 2007. And you think back to the industry before 2009. So 2009 was a pivotal year. You got in at a really interesting time, not just because of financial crisis, which was obviously crazy, but also because PacLife became the #1 seller of IUL in the country in 2009. Prior to that, it had been, Indy Life, Ameris, Aviva, now Accordia, owned by Global Atlantic. But that company had been #1 for years. And if you look back at that old marketing material, that company sold IUL. And I'd put National Life in this group too. And some of the other kind of early adopters.
I think #4 when I joined them in the country as far as.
Yeah. And they were really telling a very simple story, which was, this is a product that offers downside protection with upside potential. And that is a powerful, intuitive story. And by the way, the product does it. Now, with an asterisk, right? And the asterisk is, you can lose money because the policy charges are still deducted. So one of the things that, I think downside protection, upside potential is absolutely true in terms of crediting. It's not true in terms of your actual dollars you put in the contract. You can lose money in an IUL, but leave that aside for a second. It's a very important point, especially when you contrast it with whole life. But if you leave that aside for a second, that was the narrative really up until like 2006, 2007. And what happened in 2006 was AIG rolled out Elite Global IUL. And the default illustrated rate for that product was 10.25%. And I remember in 2007, I graduated from college in May. In June or July, I ended up going to a conference with AIG in Las Vegas at the Bellagio, where someone stood up on stage and said, someone from the company stood up on stage and said, it is irresponsible to illustrate this product at less than 10%. And I remember being in the back of the room and thinking, I don't know anything, but something doesn't sound right about this. But that to me started the next phase, which was kind of this illustration warfare. So early on, it really wasn't about illustrated performance. It was about downside protection, upside potential as an asset class story. And I think a lot of people paint me as kind of an IUL hater. And I always look back and say, no. IUL does what it's supposed to do: downside protection, upside potential. I mean, within the context of a UL product, that is what it is designed to do. And it delivers on that promise. Now, to your point, the cap will change. Right? The upside, the amount of upside you get will change, but the core story of downside protection, upside potential always persists. And that's a really powerful consumer story. But then we shifted to this kind of illustration warfare, which then led us to AG 49. And then you get this kind of post AG 49 world where companies are doing all these multipliers, where they're basically now putting more risk in the product to get more illustrated upside. That leads to AG 49A. And now we're in this world where everyone's saying, well, don't use the S&P, use these proprietary indices because the proprietary indices illustrate better. No one understands how the proprietary indices work, right? Yeah. And then I would argue, and I was kind of arguing in that post, that we're going to move. AG 49B will come. It's already in process, and it will clamp down on this illustration abuse. And we will get kind of these new narratives for IUL that are going to be different than what we've had in the past. And, one of them is going to be, oh, well, my in-force IUL policies have performed really well, which is absolutely true. The S&P has also been up on average 13.5% since 2009. So obviously your IULs have performed pretty well. And by the way, caps were really high and now caps are a lot lower. So there's these kind of new narratives that are coming out. But I think the big thing is the story has kind of continuously tried to unmoor itself from what the product actually structurally does, which is downside protection, upside potential. That is what the product is designed to do. But that kind of died in 2007. And from then on out, it's been this illustration warfare kind of nonstop ever since. And that I think is the tragedy of IUL is IUL, there's a place for IUL, but the problem is the place that got really overemphasized because of the illustrated performance. And that was never the point of the product. The point of the product was never to have it illustrate better than a UL or better than a whole life. The point was to do downside protection, upside potential. And yet it's been twisted into this illustration story. And so, so that's how the narrative's changed. And I think to the extent we get away from the illustration story, that's the extent to which clients can actually understand what they're buying. And I think even you told that story about the PacLife, the guy selling the PacLife policy. Yeah. I guarantee you that most of that story was around the illustrated performance and around the index and around the look back.
Oh, you know what he did? So here's the deal. He went in and he said, hey, listen, this product has no cap on it. Right. And he goes, argue with me on this. This has no cap. Look at this 1 year, it made 37%, right? And what did he do? So he went, listen to this. So he shows his own policies, like, I own this, I do this, and let me show it to you, right? And he showed me March 1st, 2020 to March 1st, or February 28th, 2021, which is like, COVID.
Perfect.
It was the perfect timed out. And it took me 3 milliseconds to be like, are you kidding me, man? Really? You're going to cherry pick this one perfect 12-month period?
Yes, he will. I mean, guys, but think about it, right? The same logic applies to the last 10 years as a whole. It's been a crazy good run for IUL. And the analogy I use in that article that I was kind of on the fence about using, because it's, I could see people thinking it's kind of insulting, but what that guy did is the equivalent of like somebody walking into a gas station, winning a lottery ticket, and then running out and going, look at me, I'm the best lottery ticket picker there ever has been.
Totally.
Give me your money and I will buy tickets for you. Like, dude, you got lucky. You hit the jackpot on your lot, so, but that's part of the thing is, like, I think with IUL, all these people tell all these other narratives.
Yeah.
When the reality is, man, this is a universal life policy where the company, instead of giving you a fixed crediting rate, puts the money into options to give you index exposure.
Yeah.
That's it. It's nothing crazy. Yeah. It's nothing sexy. It's really nothing that different than just a standard UL contract. And so one of the things I do, like when I try to break through these narratives, and I don't talk to clients, I'm not a licensed agent, but occasionally people will find me on the internet and kind of this situation, right? Like, I've been pitched this deal. How do I think about this? And I don't talk about IUL. I go back and I say, let me explain to you how any permanent life insurance policy works. Whole life, UL, whatever, start there, and then we'll build into what makes IUL different. And by the time you actually educate someone on what this product is, they can see it from the beginning. They can see what it can do for them, and they'll immediately realize that the illustration is essentially worthless. And they'll say, okay, if I want to buy this product, it's because I have a permanent insurance need, or I want to accumulate cash, that I'm going to have charges that come out, and I can always lose money for my policy charges. And instead of taking a fixed rate from the insurance company, I'm willing to let my equity performance bounce around between this floor and this cap, recognizing the cap can change. If you get a client there and the client still wants to buy IUL, then you should feel great about that sale. The problem is most clients don't get pitched that. They just get shown an illustration with an illustrated rate, and that's the end of it. And that is the tragedy of IUL.
It is. And most clients just really don't understand what they're actually buying.
No.
That's the sad truth.
No.
So, okay, I've got like 10 questions bouncing around in my head based on, as you were going through, I'm like, ooh, I just didn't want to interrupt you, right? So so let's talk about, since AG 49A came out, right? The companies have gone to this instance where so I always tell people the IUL space has kind of created their own problem. Like, their own success has led to their own demise in a way, right? Because what's happened is, back when I was in the business, selling IUL with National Life, and they were number 4 in the country, there were like 12 companies, 13 companies selling IUL at that time, right? And so it was a very small market. Now we're near 50. How many companies do you think right now?
It's a big number. 40 something, yeah.
It's a big number, right? Yeah. And so, okay, if that's the case, now we have, if you understand the fact that, companies are participating in the indexes by buying call options. And so now you have all these companies that are like competing for these call options. So supply and demand is an issue. So the more it's like their success has created competition, which has driven up the cost, which in a decreasing interest rate environment, that's put pressure on the general funds. The competition is driven up, demand on the options, which has driven up the costs. So they have a smaller budget and higher costs, and that's why cap rates have come down. Is that a fair assessment?
It is. There is a correlation there that is, I'm not sure it's causality. The correlation is we've seen a lot of carriers get in the space and a lot of flow in the space on the FIA side and the IUL side, and option prices also have increased. That is a very strong correlation. I tend to agree with you. And in talking to some market makers, I think it is true that there is a supply and demand imbalance. It's really hard to measure that. I'll tell you why it's hard to measure that, because if you think about it, carriers, when they trade these options, they don't go to the Chicago Board Options Exchange and trade, exchange traded options. They don't even do flex options, which are customized exchange traded options. They literally call up the investment bank, and get a quote. And so the challenge is that we can't really see a lot of the flow and how the flow is moving because it's not publicly reported. You have to see it in the carrier's statutory filings. Yeah, so it's a little bit bizarre. And here's the other thing too. So where do you see supply? Where would you see a big supply and demand imbalance? Well, and where would you really pay through the nose for that? Well, it's kind of not in the normal like course of things. It's whenever volatility gets pretty high. So March 2020 is the kind of key date, because what happened that month was basically every IUL company went to the investment banks to try to trade their blocks. Now, remember, they trade on the 15th of the month generally.
Yeah.
They go out to try to trade the blocks. There's only one counterparty that steps up to take those trades. And the carriers paid 20, 30, 40 basis points more than fair market value, which was already really high because volatility was high, just to execute the trade. So I do think there is a bit of a dynamic going on right now, really for the first time ever, where, to your point, there are stressors on the options side that we really haven't seen before. And carriers are kind of going, to your point, are we getting too big? Like, are we creating systemic market risk because we're too big now? We can't clear a trade. We can't get a fair price on a trade. We can't find a counterparty, because back in 2009, we were asking for $10 million worth of an option trade. And now we're asking for $1 billion in a month to trade options. But those are two totally different orders of magnitude. So I do think there's a little bit of that going on. And there's some really quirky stuff to that. But again, I think it goes back to saying that at the end of the day, IUL is an options strategy. Anything, any understanding you have of a cap or a floor or a spread or an index, all of that inevitably has to come back to options. And so one of the things I always tell advisors is you cannot understand, like as an advisor, you cannot explain IUL without understanding options. And the problem is this is a non-registered product, so which means that there is no options education required for you to sell this product.
So great.
And so you can't understand, like even just your statement, like you can't, as an advisor, you can't understand why a cap would drop unless you understand options. And and most advisors who sell this stuff do not understand options. So if they don't understand it, how can they communicate that to the client? And that's just a huge disconnect. There's nothing scary about options, right?
No, totally.
Yeah, it's a key part of the story. It's kind of the power of the downside protection, upside potential story comes from the options. But it's just amazing to me that guys run around talking about IUL as if it's not an options product. It is an options product. You are always a victim of whatever happens in the option market.
That's so true.
You can't ignore it, you know? So anyway.
Can you talk in more detail? Because I try to talk about this as much as I can, but you're probably infinitely more articulate about it than I am. When companies shifted to the no cap products and the proprietary indexes, right?
Yeah.
And I mean, you've already talked a little bit about why they did that, but that's a story that is being sold by these people, because like my whole thing is, look, companies can reduce your cap rates, it can increase your charges, it can do all these things. And then the default response is, there's no cap rate on this. There's no cap rate on this. So your argument is nullified, right? So can you talk to me about for everybody out there who is buying a no cap rate, thinking they're getting away from that danger?
Yeah, it's a great question. And you're right. This is part of the new narrative in the IUL kind of world is, these proprietary indices get around the problems of the old product. So the simple, I'll just give you a simple thought process here. So imagine you have an S&P strategy with a par rate. And anybody who's been an IUL long enough will tell you that par rates move around more than caps. And there's an options reason behind that, right? With a cap, you have two options. With a par rate, you have a single option. So it's more volatility sensitive, without getting into the weeds on it. But so you have a volatility impact. So imagine you have a scenario. I'm just going to give you some real numbers here. Let's imagine you have a 100% par rate a 60% par rate in the S&P in January of 2020. If you were to renew in March of 2020, you would probably have somewhere around a 15 to 20% par rate in the S&P. Yeah, it's brutal. Yeah, right. But here's the thing. Why did that happen? Well, that happened because volatility went through the roof, which means the options got very expensive, which means the carrier then, to your point, they have the same amount of money to spend. And so if the options get more expensive, what do they have to do? They have to lower the par rate. So, and actually from a fair market value standpoint, the 60% par rate in January that you would have gotten is the same market value as the 15% in March. Now, here's the thing with the uncapped indexes. Now, imagine I come to you and I say, okay, you want 100% par rate? I'll give you 100% par rate. But here's the deal. I'm going to give you the 100% par rate, but it's going to be on this volatility controlled index. So this volatility control index has a volatility target of, let's say, 5%. And the way that it achieves that volatility target is that you have an equity component and you have a cash component. And if equities go up, then more cash is in the index. And I mean, sorry, if equity volatility goes up, there's more cash in the index because, think about simple math, right? If volatility goes from 20% to 50% like it did in March, then I have to put whatever, a lot more cash in to still get my same volatility target of 5%. So when the client actually thinks about this index might be in March, in January, that index might be 60% cash, 40% stocks, or 40% S&P. In March, that index might be 95% cash, 5% S&P, with the same 100% par rate for both January and March. So the 100% par rate is it's a red herring. It's, hey, you like the idea of 100% par rate, great. I'm going to give it to you on an index where when volatility goes up, I'm going to put you on an index that's 95% cash. So your par rate isn't 100%, it's 5%. Because it's 100% of an index that is 95% in cash, 5% in stocks. And that's the part people don't get. So if you look at these uncapped proprietary indices and you go back and look at what they were actually allocated in March, most of these proprietary indices were 90+% allocated into cash or fixed income. So people, the uncapped story is, it's amazing to me that clients buy into this, because the first thing they should ask is uncapped exposure to what? And the answer is an index that blends in cash to essentially drop your participation rate, which is exactly what you would see if you had an S&P strategy. It's just that the index is blending into cash, so it's effectively dropping your par rate behind the scenes.
Yeah.
The actual par rate is dropping it in a way you can see. And so the uncapped indexes don't get around that problem. And that's part of the reason why, if you look at the actual performance for these indexes, it hasn't been great for a lot of them. And even the ones that have been great for sort of weird reasons that are not repeatable reasons. So the idea of having uncapped, again, I mean, just a logical question, ask what uncapped exposure is, go pull what that index is actually invested in. And again, most of the time you'll see that index is mostly in cash or bonds, which means that your par rate isn't really 100%, it's 40% or 30% or whatever it is.
So with
Does that make sense from
no, it makes total sense to me. I mean, it may be over some of the people who are watching this, over their heads a little bit.
Well, let me just say, the reason why I asked the question is, if you don't get what I just said, then don't do the uncapped indexes.
Okay, fair enough.
I mean, literally, if you don't understand that basic point, you have no right to go out and sell an uncapped index.
100%. Period. And so to that point, right? Do you think, because of the fact that we have all these agents out there selling this concept that they don't understand, putting people in a product that they don't understand, and potentially if you invest in something you don't understand, you're putting yourself in harm's way and you're putting your money at risk unnecessarily. That's what I believe, right? And so is that, you mentioned in a couple blogs that you've written recently, talking about AG49B potentially kind of being forthcoming, right? Can you talk about that? And is that going to be designed to help kind of mitigate some of these risks of people running around and,
Yeah, no, it's a great question. The way I think about it is I had a friend in high school whose parents, they either loved him or they hated him. They bought him a Dodge Viper when he was 16 years old. And and
they want him to die.
Yeah, well, that's what I'm saying. I couldn't tell if they loved him or hated him. And he wrapped it around a tree. I don't know. I mean, I think it was a month he had it, and he wrapped it around a tree. Yeah. And then they bought him a Range Rover, an old used Range Rover, and he wrecked that one off-roading.
Okay.
So this kid, so the thing you can know about this kid right away is this kid basically can't be trusted with any sort of vehicle with any sort of real capability. So they ended up buying him some I don't know, some clunker after that, right? Which they should have done in the beginning had they known their kid. A very similar thing going on here with IUL, right? They had the carriers had Dodge Vipers and they wrapped it around a tree, and producers jumped in the Vipers and didn't know how they worked. And like I said, they wrapped them around the tree. And then we get AG49 and they get this Range Rover, which is different, right? And then they go and they off-road and they don't really know what they're doing and they break the axle and it's over. Okay. And so I think that's kind of, so one solution is, well, let's just keep giving this kid different cars and hopefully, he'll behave well in the car and not ruin it based on the car's capability. Yeah. Or you just need to not let the kid drive the car, or, and so I think that's kind of where AG49B could go, is to say, hey, you're not ready yet to we can't trust you to go out and do this. And I think for the last few years with AG49, they've let producers unwittingly drive these Vipers and do these things they weren't not equipped to do. And I think one potential outcome AG49B is, to your point, sort of saying like, hey, we cannot trust the actors in the business to make the right decisions. We cannot trust them to not wrap the car around the tree. So we can't let them drive. We're gonna restrict the illustrated rate on IUL to the option budget, for example. That's one outcome. It's possible that happens. I think the more likely outcome, just based on how this process has gone for years, is that they basically just give them a new car. And they say, oh, well, you can't do the prop indexes with the bonuses anymore, and then the carriers will find some other thing to do. And we'll be back at this in a few more years. And then hopefully maybe they'll at that point say, hey, we can say, hey, you guys can I lost my train of thought because I had an invite pop up. Sorry, man.
Oh, that's cool. No
Whatever. You see what I was saying? Like, I think at some point down the road, maybe they'll make the right call and take the wheels out of or take the keys out of the kid's hand. But I don't know if AG49B is going to be it. It may take a C or a D before we get there.
Yep. Well, either way, though, it's like, so anyway, I know we're coming up on time here, but I tell you what, man, this has been a blast for me. I know that, hopefully people are finding a lot of value in this. I know that just the education that you've been giving in this call alone is to me invaluable for people to be watching. So I would love to have you back on the channel sometime.
Yeah, man, let me know.
And once again, guys, go check out LifeProductReview.com. Hopefully you found value in this. If you did, make sure you hit that subscribe button, smash the bell. That way you get notified every time we launch a new video. That way you get notified next time Bobby's on the channel. But anything else you want to say, or are we good?
No, I appreciate the call and I appreciate what you're doing. And yeah, man, thanks for having me.
You got it. All right, guys. Well, have a blessed, inspirational day, and we will see you on the next video. Take care.